All right, so I wanted to touch on three specific things for
Sure.
this after hours. The first one is okay. Let me just set it up here. So the question is, we've had the biggest drop in the Nikkei since 1997. We've had China now adding 1 trillion renminbi since July 25th to their markets, and so it's completely into the global economy. U.S. bond yields are doing lower highs and basically getting lower lows. Right, the yield curve is un-inverting, which is generally really bad news for markets in the short term. High beta dropping like crazy. Gold though up to 2,500. So when
Mhm.
gold goes up and equities go down, that's bad. And the unemployment rate is continuing to tick up. Today it ticked up to 4.3%.
Mhm.
Is this the beginning of the burst of the dot AI bubble?
It's a tough call, but it's difficult for me to not admit that in many historical instances, the stock market usually signals a recession first before we get data to indicate a recession.
Right.
And those sell-offs tend to occur in advance, and then they start to recover. The market almost always seems to recover before the recession has really taken its course,
That's
right?
right.
So if we see increases in unemployment and two down GDP quarters, we are officially in a recession, a technical recession. We haven't gotten that data yet, but we are starting to see signs of a fairly large sell-off in markets, and it's heading in the direction that we might consider this initial signal. If the Fed intends to lower rates in September, which right now, the last time I looked up the CME Fed Watch tool, it was 93% chance that we were going to cut in September. And let's look at
Well,
the
forget the
overall.
FedWatch tool. Did you watch Jerome Powell? He all but promised
Yeah, he's
multiple
like,
cuts.
yeah, now, in fact, many people are now predicting it's a 67% chance that it's a 50 basis point cut,
That's
not
right.
even just 25 basis points.
That's right.
So if cuts are coming, and I think Bill Ackman echoed this on Twitter, a couple months back or maybe a month ago, that is the signal of a recession. When rates start coming, are getting cut, that is almost always a signal of an inbound recession. So if that's true, I don't know that the answer is the end of just the .com or the .ai. That's a really good name for it. Boom, but rather some kind of correction in markets as well as the overall economy, and we start to find a new footing, I think. What are your thoughts?
Well, what I think is that we'll never have a .com like drop again. I mean, if we are going to have anything like that, it'll be such a massive collapse through a catalyst that causes the markets to completely give up the ghost. That because .com happened, even GFC happened before quantitative easing. And since quantitative easing, since global financial crisis 2008, 2009, all crises have been met with massive injections of liquidity. Now, the China added in 1 trillion of renminbi. We don't really get to see a lot what's going on in the China economy, but they're leading. They're leading in the supply chain, and so when they pump money in, it generally flows. I mean, a lot of people credit the China goosing their economy for helping to get the world out of the recession in 2008 to 2009. So that's already starting. I don't know what's going on. We're seeing the Japanese yen bounce from a bottom. We'll see how long that bounces up, but it only bounces when the Bank of Japan um, is trying to support the currency. So there seems to be some machinations. Janet Yellen was in China in the East trying to deal with the whole dollar liquidity over there, and then we see the dollar like plummet today, and so liquidity. I mean, liquidity is coming. And then after what Jerome Powell was saying, and he knows that the unemployment was going to tick up today. Like he gets the number beforehand,
Mm-hmm.
and so like they all know this, and so I think it's just preparing for this liquidity surge that to me it's sort of it's when I see Bitcoin that Bitcoin is not down to 56,000, I go, okay, then Bitcoin to me is like the most precursor liquidity signal. If we do hold here and start moving up, I think we're going to see just a massive this massive run up I've been talking about for the last couple of months in all these different assets. And what we've been seeing in the stock market is that this drop happened during a window of weakness. Like this drop, what, a 6% from the high for Nasdaq, for SPY, the run up in gold. This all happened. We had the top right around the assassination attempt for Trump.
Mm-hmm.
So boom, we increased volatility. The prediction markets even show that we increase volatility. Then Biden disappears, COVID disappears. Then uh, trying to get him out of the race. Then Kamala comes in. Kamala's numbers go up dramatically for in the odds go up dramatically in her favor for the markets, for the polls. Well, that means volatility is back. Like volatility is like, we don't know what the next 4 years might be like. Where just a little while before it felt like all but certain Trump would have led, and so the economic policy we could have predicted, and so that volatility coincides exactly with these tops, and it all happened exactly in the window of weakness um, in July, when volatility wasn't very well supplied and dealers were short gamma. Well, what happens then? Then you get this. If there's any price decline, and it happened because of volatility, the gamma accelerates it, and now dealers have to sell in order to keep pace with the fallen assets. Well, that only happens all the way to the next burst of liquidity, right? So if that happens, and I think it'll happen the first 2 weeks of August, then we get the floor in, the puts stop printing, the calls start printing, and now we launch in the other direction. And we launch in the other direction while there's still the short gamma effect. Well, then we'll just skyrocket we'll V bottom and like COVID level rising back up if this liquidity is actually coming in. You pair that with cuts, and what was Jerome Powell saying at the conference? And they're really now saying this very clearly, that the Fed is running an expectations-based policy. That they know that just announcing that they will cut, or is very likely that they'll cut, is all that's necessary to cause the market to inject its own liquidity and cause asset prices to go up. And so everything to me is pointing to the stock market and crypto is going to go up and to the right, starting within the next 8 weeks. That's what it seems like to me.
I mean, I'm definitely a supporter of the idea that markets often surprise. So as we start to develop a sense that trend is heading downward, I am never surprised anymore when that completely reverses and heads to the upside again. So as a technical analyst, I'm going to be very interested to watch where we start to cross some pretty solid support zones in both crypto and in equities. And if we start, developing a sense of confirmation to the upside, I won't be surprised. I'll start developing a position again. So we'll see.
I think it'll happen very quickly, though. Like just like we saw with you were just talking about with Nvidia, like these reversal moves, they no longer take a long period of time because the derivatives market is so large, right?
Well, not to mention how much control the Fed now seems to have over injecting liquidity into the markets. If that trend continues, or we start to see that occur again, I think the same effect can occur again, right? Isn't that whether we've discussed that on the show before?
Well, I think the Fed, because people forget, the Fed didn't used to do press conferences every month or every meeting like that. That's like a relatively. It started, I think, with a little bit of Bernanke and then Yellen, because they realized that the ability to affect the markets in the short term was not very great. That the interest rate changes could took 18 months before it actually trickled into the economy, and they needed to do more immediate changes. And so they started doing these press conferences, and you're like, why are they being transparent about this stuff? Well, it's because they need the people, the participants in the market, to actually modify their behavior now. Because if they modify their behavior just with them saying something, and then the markets move up, well, that creates this wealth effect, because it's a $200 trillion market, and if it goes up by 1%, well, then there's a ton of new money that's being created just by virtue of the price moving. And so they sort of like talk the market up, and so the liquidity actually comes from our behavior. like the market participants, I mean our behavior, pension plans and sovereign wealth funds and people with actual like billions and trillions of dollars, those are ones that are moving the market. And so the to me, it's not the Fed injecting any liquidity, it's the Fed removing any it's the Fed put. They're removing any worry that they're going to do anything to hinder liquidity, and that itself is massive liquidity in the short term. Whereas raising interest rates took, what is it, 2 years before it really started ramping up. Fed Powell just mentioned in the last Fed meeting, he goes, only now we're seeing the tightening effects from what we did. I couldn't believe he said that. He said, only now we're seeing it start. Don't you guys see, right? Now you're seeing that we're actually tightening. And then they go, okay, but if that's the case, and it's going to take another 18 months, 2 years for it to go up, to reverse, to ease, what shouldn't we cut now? And he's like, no, you don't have to worry about it. Us just mentioning that we will cause the market. He says it. He just gives the whole playbook.
Fair.
And so I'm like, okay, I'm not going to bet against the governments and the central banks. They're saying they're going to drive liquidity. We're seeing the numbers show we're the beginning of the unemployment cycle. All these things are happening. They're going to have to respond with liquidity and massive amount of liquidity because it's always more than they did last time.
Mm-hmm.
And so if that's the case, freaking Bitcoin to 13 million. I'm going to say it right here.
13 million.
That's what Michael Saylor is saying. 13 million on Bitcoin. I think that's what he said.
Fair enough. I'm paraphrasing.
So to me, it's this period with the skies falling makes me feel like, oh man, if ever a time to want to buy, like now's the time you want to start nibbling. As far as, I'm not financial advice, I'm just saying for myself, this is where I feel like now I want to buy, start building larger positions.
I think that has been great advice spoken by Warren Buffett. When everyone's fearful, be greedy, and if everybody's greedy, be fearful. I don't think we're quite to the fearful stage yet, though. What is the fear greed index at these days? Created by my good friend Jason Meshnick. We're at 26, which is at the bottom end of fear, but not quite extreme fear. So if we can get into a stage where the market is even more fearful, generally, yeah, that's a great opportunity for you to sort of be a contrarian and take the opposite side. But I'll be looking for where the real opportunities are, which assets are really truly undervalued or have promising upside to them. Because the toughest thing to do is to join in on a wave of downside and have to eat through that drawdown.
That's right. Well, I feel like what I worry about, and this I think in the Unknown Market Wizards book, the more recent one of these interviews with top traders,
Mm-hmm.
there's this one I really love. Man, I forget his name, but he looked like your regular Joe Blow making oodles of money, and it'd be like, what's your strategy? It's like, do you do technical analysis, and do you have fundamental things? He goes, no, all I do is I sit down and I watch CNBC, I watch the news, I watch Bloomberg, and whenever they're super bullish, I then go short, and whenever there's a super bearish, now I go long.
It's like the Jim Cramer approach.
I mean, it works so well. It works so well. And so for me, the problem I have is that as people predict, as the people I listen to, I use as buoys within the currents of the financial markets. When I hear them talk about, oh my God, there's going to be so much more downside to come, I sort of go, well, then I think we're near the bottom, because people are very bad at projecting non-linearly, and they go, okay, we fell to this level, now we're going to fall further. It's when they're calling for a bottom that I go, okay, no, we're going to fall further still. And so since I'm hearing more talk about downside risk, I go, well, then we're probably bottoming around here. We'll see.
Yeah, I don't know. I don't know that we've pulled back enough yet, but this is me being a technical analyst and really just seeing this. We just got the signal that we are starting to reverse the trend. I'm not sure that the trend has fully presented itself yet. I don't know how much further that goes, but I'm always open to the possibility that we go sideways for a while. It's not necessarily one direction or the other. The third option is always that we just stay in a range for a while.
I hate when you say that. Sideways to me is Death. I can't make money sideways. I can only do it up or down.
Well,
All
we
right,
can
fine.
make money sideways in options. If you see it coming, then we can at least construct a good options contract there. That
Okay,
is one
so
opportunity.
fair, but then we're back in the options problem
Yeah,
of
yeah, yeah.
I got to be right in timing for that whole thing.
But you're
I
not
make
trading
money.
directionally anymore. That's kind of the upside to that type of strangle is that we're not betting on direction anymore.
Right, but you need the price to stay within that volatility range.
That's true.
And
That's
then
true.
if you're like, okay, I'm making money, and then it pops up, and you go, okay, well, I mean, if you're selling the option,
Hmm.
well, I guess if you're selling the option, I hate selling options.
I see.
I
Yeah, yeah.
can't sleep at
That
night if
gets
I sell
tougher.
options.